career with American Express Financial Advisors, Chad spent 14 years with Simcoe Private Wealth overseeing the investment committee, developing relationships with clients, helping them through key financial decisions, and was the COO of Simcoe from 2007 to 2012. In May of 2014, Chad joined Aveo Capital Partners as a private wealth advisor. Chad and his team are passionate about aligning wealth with purpose. Their goal is to create a safe place for their clients to unpack all things financial so they can go and experience life to the fullest. Whether that is changing careers, retiring, or giving back in new and creative ways, Chad and his team strive to create a wealth plan that aligns with each client's greater purpose. Chad, if you're ready, I'll hand it on over to you. Everyone, please hold on one moment. We are having some audio difficulties.
Alex, can you hear me now?
Yes.
Okay. All right, let's start over. Sorry about that, everyone. All right. All right. So I guess nobody could hear me. So I just wanted to say good morning and good afternoon, everyone. Thank you so much for taking the time to listen in today. You know, this is the time of year when business owners begin doing an assessment of their current year, as well as planning for the next year. So I thought it would be a good opportunity to present the concept of aligning your personal financial goals with your business goals. My goal today is to accomplish two things. First, I want to share some best practices on how to get more out of your business so you can accomplish both your business goals as well as your unique personal financial planning goals. And second, I want to give you some examples of retirement planning tools for different phases of your business. I'll wrap up in about 45 minutes to allow for questions and answers at the end. So I thought it'd be best to start with some questions for you to ponder. So the first question we often ask our business owner clients is, what is the purpose of your business? Most of you might say, it's bringing your product or service to the marketplace. or you like working for yourself. It provides a lifestyle for your family. You like being an entrepreneur. You like building something. And perhaps for some of you, it's your retirement plan. But I think it's something good to think about as we build our 2018 business plans. The next question, in 2018, by how much do you want to grow your business? And why is that important to you? If you're like me, when you started your business, you didn't really think about how much you wanted to grow. You just wanted to grow. You showed up every day, worked your tail off, and grew your business. Perhaps you finally reached a point where you felt like you could stop, take a breath, kick back a little, but something inside you said, I just want to keep growing. So why is growing important to you? One answer I often hear is that you still aren't where you want to be financially, or you aren't quite sure if what you are doing in your business will bring you the success you want or need. The next question we often ask is, how do your business growth projections tie to your personal financial plan? Well, some of you might say, I don't even have a financial plan, so I can't answer that. That's absolutely fine and probably the most common answer we hear. Hopefully by the end of the presentation, you'll have a better grasp on what it would take to be able to answer that question. The fourth question that I'd like you to think about, and this is more granular, is how do you decide which retirement plan is appropriate for your business at various stages of growth? From my experience, most business owners I meet with really have no idea why they have the type of retirement plan in place in their business, or they have one and no one has talked to them in a really long time on what their other options may be. So in the second half of the presentation, I'll run through some scenarios that may help you analyze the plan that you have in place and what might be best for you and your business. So I quickly wanted to go through the financial planning process. If you haven't been through it already, this is a typical four-step process. So first step when you meet with a financial planner is we call it the discovery phase, and it allows you to let us know what your goals are. It's oftentimes asking a lot of questions back and forth, getting to know each other, and at the end of the meeting, there should be some pretty clear goals that you have in place. Then the next step we move on to is the assessment, where we take where you are currently and compare it to where you want to be. And oftentimes we'll use the financial planning software for the assessment phase. And then the third step is we come back to you with recommendations on how to implement some changes in your life or your business to get you on path from where you are today to where you want to be in the future. And then the fourth step is to monitor and manage all those changes. Some people like to do that on their own, or others like to continue to work with a financial planner. So what I thought would be best would be to take kind of a classic example of a business that we have worked with in the past and walk you through their financial plan and to see how their personal financial plan affects their business decisions or vice versa. So this is a B2B service company instead of B2C. This is a business that sells to other businesses. And we met with this owner several years ago. And during the discovery phase, we basically found that they had three main goals. Goal number one was they wanted to retire comfortably in about 15 years. Goal number two, they had an 8-year-old daughter, so they wanted to pay for 4 years of in-state college tuition in about 10 years. And goal number three, the CEO of the business was very concerned about the family's financial security if something were to happen to him. So three big goals to try to accomplish. So in the assessment and findings phase, here's what they were currently planning on. In terms of a retirement plan, basically they looked at their business, which for most of us is our largest asset, but their plan for retirement was to grow the company and to sell it in hopes that it would help fund their retirement. They really had no idea what the value of the company was or what the marketplace was to sell it. And then they also didn't know if what they could sell it for would be enough to retire on. In terms of college, they had a small brokerage account or UTMA account, which stands for Unified Trust Minors Account. Basically, the account becomes the child's at a certain age, depending on the state, but they weren't currently contributing to that. In terms of risk management, the CEO did have a $300,000 term policy that would cover the college years, and basically was set in place to pay off the mortgage in case something happened to the CEO. Some other information that you might want to know is the CEO was averaging around $200,000 a year out of the business, but wasn't actively saving for retirement or college. The business was actually growing, top line growth, about 10 to 12% per year, but so were expenses. So the income of the CEO wasn't really changing, and they just came to us for some advice. Were they on the right path? What could they do? How could they do things differently? So this is a classic business that we see is, and what do I want you to focus on here is just revenue. This is gross revenue, and then expenses. As you can see, the expenses are growing as the revenue is growing. The net, everybody does their financials slightly different, but net in this case is what the owner was taking out of the business. And you can see that it's slightly growing, but not at the pace at which revenue is growing. So the first step, or first recommendation that we made to the business owner and the family was to have a professional valuation performed on the company. And a lot of people don't even know where to start with that. Our TAB board is actually going to have a guest speaker at our next board meeting to talk about the process that a business owner could go through. But I think that's really important in the financial planning phase, especially with business owners, because it is your largest asset, or could be your largest asset. The client did take our advice and found out that their business was worth about $1 million to 1.5 where it stood today, and that's pretty typical. So a lot of times when companies get valued, you may have heard the term EBITDA, or earnings before interest, tax, depreciation, and amortization. Basically, what's the profit of the company. And for small businesses, roughly people can get 5 times EBITDA. The average across the United States right now for privately held businesses is 8. Some are selling for more, some are selling for less. But as I shared with you, it was about $200,000 of net that the business was generating. 5 times that was about $1 million. So it was pretty in line with what we've seen across most markets. The next recommendation we made was for the business owner to sit down with his team and look at various growth rates of the business to determine, number one, are they reasonable and attainable? I mean, we all build spreadsheets and have our businesses grow at exponential rates, but we have to be realistic. And 2, could we use that data to make a decision on what growth rate would help the family or the CEO have the highest probability of success in reaching their goals, their personal financial goals. So here's part of the presentation. We're going to get really granular. So hopefully you aren't emailing right now. But what was built here was looking out into the future and looking at 2 different growth projections. And on the left, you have a 12% top line growth, expenses growing at about 10%. So the nice thing for this business owner, if they could reach that growth target for the business, their personal income starts to expand, which is really great. And then we could compare that to say, well, what if they had even more top line growth, say 15%, and instead of 10%, the expenses grew at 11%. So even more of a net margin profit increase. The nice thing is, as financial planners, we can take that potential growth or the net on either case and plug that into the financial plan to see how that would affect their maybe their retirement scenario. So that's what this slide is doing here. On the left, we have some projections that we have to think about. So oftentimes when we sit down with any client, we ask them how much they want to retire on. So this number on the left, that $150,000, that's basically what the business owner is living on today. And perhaps they want that home to be paid off. So it's the $200,000 that they were pulling out of the business minus taxes. But most people want to replace that type of income in retirement. Maybe their house is paid off, but they want to spend more time traveling. So we typically see it's about what people are spending today that they're going to spend in retirement. historically, I think our industry has told people that they should spend 70% of what they're spending right now in retirement, but I've not seen that be the case because people want to live a better retirement and they're living longer. So, but one thing that people kind of forget is that nasty word inflation. So on the line that says $150,000, if you were to inflate that at 3.5%, which is about the 100-year average of inflation, in 15 years when they go to retire, they actually need $251,000 to have the same lifestyle. Now the next line where it says need or net, to generate that amount of money with no other income sources, so they're not working or maybe they don't have Social Security or any other pension, we recommend right now about a 4% withdrawal rate. So to generate $251,000, they would need to have a pile of money worth about $6.3 million. Remember, I said that for many business owners, we call it the Hail Mary financial plan. Their whole retirement plan is to sell the business. And to net at about a 25% tax rate, to net $6.3 million, the business would need to be sold for $8.4 million. So without any other planning, you can build a growth projection on how much do I need to grow my business by to sell it for $8.4 million, assuming a 5 to 6 times multiple of earnings, to net $6.3 million. And that's what that blue line is the 15%. So as a business owner, you can sit down and say, okay, to meet my personal financial goal of retirement, if this is how I want to build my retirement plan, is 15% attainable? And then there's a whole nother discussion on, what about technology changes? Will there be a marketplace for my business in 15 years? All those big, hairy, nasty decisions and questions that we have as business owners. But at least this is the data that one could use in assessing a growth rate for your business as you look into 2018. The next two lines, though, are saying, well, what if we did hit 12 or 15%? We're going to have extra money. We're used to living on $200,000. In 2018, if we grew by 12%, I might be able to make $259,000. Well, we just built some projections for this client and said, well, what if in 2019, so that's why it says 14 years instead of 15, the CEO and his spouse started saving $18,000 a year into, say, a 401k plan, and they did that for 14 years. And let's say they earned an 8% average annual rate of return. Well, that $36,000 over 14 years at 8%, it ends up equating to $871,000. So if you subtract that from the $6.3 million, now you only need $5.4 million out of your business. Gross that up before taxes, and you don't need to sell your business for $7.2 million. So by saving today, it takes a little bit of pressure off what you need to sell your business for in 15 years, and that would be the 12.5% line. And then finally, if let's say they had really good growth 2018, 2019, like 15%, and they were able to save even more. In fact, for 2017, the most you can put into a 401k and profit sharing plan is $54,000 per person. Let's say the CEO was able to do that instead of the $36,000, and they did that for 14 years. Now they have $1.3 million at the time when they want to go to retire, which would equate to their business only needing to net on a sale of $5 million. So that's a 12% growth rate. So the point here is, by looking at these different projections, realigning some of your maybe the expenses, maybe that's an issue that you need to focus on in your business. Is I've seen a lot of business owners where they just they want to grow and they don't always pay attention to the expense line, and so they're growing top line, but they're also growing the expense lines. Maybe just shifting that in your overall plan for 2018 could create some space to begin saving for retirement, so that your retirement plan or your financial plan isn't entirely based off of the growth of your business. And obviously we want to enjoy the work we do. We want to enjoy going to work. And so the less pressure we can be putting on ourselves to grow our business, the more enjoyment we can have. So hopefully that makes sense to everybody. The third implementation, and I'm just going to touch on this briefly because it doesn't completely tie into the conversation today, but I wanted to complete the implementation phase of this example. And also, it may fit for other people. One thing I will say that any of the recommendations or scenarios that I'm talking about today are not a recommendation for any of you. Everybody's plan is certainly unique, and your goals are unique as well. But in this particular case, when we met the client, they were underinsured for that one goal, and they weren't saving for college or retirement. And so we had asked them, like, well, if you continue to make 200 grand, is there an amount of money that you could, if you were really managing your budget, you could set aside for something else? And they said, well, we probably could do $18,000 to $20,000 a year into something. So in this particular case, we bought a universal life insurance policy on the CEO, and we funded it at $20,000 a year. So universal life insurance policy is a form of permanent life insurance where part of that $20,000 a year is going to the cost of insurance, the $2 million, and whatever's remaining goes into a savings account and earns interest. And so the nice thing about it was, with this one tool, we were able to accomplish part of all three goals. So we put $2 million of life insurance in place, and they were forcing a savings plan, which they can actually borrow against the cash value or the savings portion of that life insurance policy for either college or for emergencies. Whereas, a traditional retirement plan, it is a bit harder to get that money out. So in this particular situation, it was the right fit. The other reason was, if they put a 401k in place, they had quite a few employees, and they just weren't ready to start contributing on the employees' behalf, meaning they would have to put in so much money for the employees that they really wouldn't get the benefits that they felt they wanted. So in this particular situation, it wasn't quite the time for a retirement plan, but a life insurance policy fit in nicely. And then the fourth recommendation was to just set up a 529 plan, which is a college savings plan. And in some states, you get a tax deduction on your state tax application. And we said, look, just start putting something in, whether it's $50 a month or $100 a month, just start focusing on that, and you start living without it. So it was automatic right out of their checking account into the 529 plan, and that worked quite well for them as well. And then finally, we kept working with this client over the years, and there came a point where the employees actually did want a 401k plan, and the company had grown, and so they felt it was a good time to implement that. They're still funding the life insurance plan, but they decided to pay the cost of opening a 401k plan so that the employees could at least put in their contributions to begin saving for retirement. And then we continue to meet with them to see if their plan, their needs are changing. And that's a good segue into the second half of today's presentation, which is, I wanted to give you guys some scenarios of different stages of companies and what type of retirement plan might fit. And again, these are not recommendations for anyone, particularly on this call, but oftentimes I meet with business owners, and they met with some sort of an advisor, whether it was a CPA or a person who specializes in retirement planning, and they got a recommendation for one particular tool, but it wasn't tied to their financial plan or their budget. And so they don't really even know why they have the plan in place. Oftentimes I just met with a client recently, and they had a 401k in place that was costing them about $2,500 a year, but they were only putting $3,000 a year into it. And I said, well, what's the purpose of this? And they said, well, I do want to save for retirement. I said, what's your budget? And this is scenario one that I'd like to talk about, or the left part of the page, where maybe the cash flow, the business isn't quite where the owner wants it to be. They don't have a ton of excess cash flow, and so they just want to save, something into a retirement account. Well, if it's less than $5,500 that you're able to save, perhaps a traditional IRA or a Roth IRA fits. There are some limitations to these in terms of how much you make, but if you or your spouse don't have access to a retirement plan, there's actually no income limit on a traditional IRA. And the limit that how much you can put in for 2017 is $5,500, and if you're over 50, you can do another $1,000. So if a couple could do $11,000 plus the $2,000 for if they're both over 50, and you don't need to fund that until you file your tax return, April 15th. So that would be for more of an early stage company where there's not a lot of excess cash flow, but the owner does want to begin saving for retirement. The next scenario would be a small business that has quite a few employees, but maybe the business isn't quite where they want it to be, so the owner is just not ready to save as much as maybe a 401k offers, and they want to keep expenses low. Well, in this situation, a simple plan might be the right fit for this business and this business owner. Very low cost. In some places they don't charge at all. And the max that a person can put in is $12,500 or 100% of their compensation. So more than a traditional IRA and less than a 401k. And then the match or the contributions that the business owner has to put in for their employees is a little bit less than a traditional 401k. So it works in one of two ways, is that you can either put in 2% for everyone that works for you, including yourself, and that's whether they contribute or not. Or some owners that we meet with say, well, I'd rather reward those who save their own money, and they do what's called a match. And with simple plans, it's a 3% match. So if the employee puts in 3%, so would the employer. But you would only be contributing to those that are putting in money themselves. The next scenario would be, and we see this quite a lot in Denver, there's a lot of consultants here, and some of them do quite well. So maybe there's someone who's self-employed or a consultant, and they're actually doing quite well. And in this scenario, they may have two options. One is called a solo 401k, and it's just like it sounds. It's for one individual. It allows them to put $18,000 a year or 100% of their compensation. And if they're over 50, they can do another $6,000. So just like a traditional 401k, but the costs are much, much lower. The reporting is much simpler, and it might be a good fit for a person based on their budget. For those that can afford to do even more, and especially if they don't have any employees, perhaps a SEP IRA is the right fit. Again, very low cost. You can open up a SEP almost at any brokerage house. It's just like a simple application, and you can put up to $54,000 or 25% of the owner's compensation. So if you pay yourself out of your LLC, depending on how you do that, it's roughly 20 to 25% of what you pay yourself, up to $54,000. So those are two ideas for people that may be listening that have their own business and are self-employed. The issue with the SEP that I've seen is a CPA may recommend it to a business owner that has no plan. The business owner has a few employees. Well, when you set up a SEP, there's some elections you have to choose, and one of them could be that you have to have worked for me 3 of the last 5 years for me to make a contribution to you. So what happens is the business owner has a SEP IRA for 2 years, and then they go to make the contribution in the 3rd year and haven't checked with anybody, and then all of a sudden they find out they have to put in a pretty hefty contribution for all of their employees that have been there 3 of the last 5 years. So that's a snag that I often see. And so sometimes we've worked with clients where, early stage company, they do the traditional IRA. Then they grow a little bit more, they move on to the simple or a SEP. And then when those no longer fit, then we move into this 4th suggestion or scenario. That's an established company. Profits are pretty good. They don't mind the expense of administering a 401k plan, and they have employees that they want to reward. So they open what's called a safe harbor 401k, and they can layer on what's called a profit sharing plan as well. You don't have to do the profit sharing every year. That's an elective part of it. But the safe harbor 401k, the reason it's called safe harbor is that there are rules and regulations in place to keep CEOs from putting in a lot into their 401k and not putting in any for their employees. And so there's 2 tests that 401k plans have to pass, and you can get out of taking those tests if you offer what's called a safe harbor 401k. So again, the amount people can put into a 401k is $18,000 per year, or 100% of your compensation. And if you're over 50, you can also do a $6,000, so that's $24,000 if you're over 50. But the match and the safe harbor part's a little bit different than the simple. With the simple, it was number 2 and 3. With the safe harbor 401k, you can either do 3% to all of your employees. So if you want to know exactly what your fixed cost would be, some would want to know that, and they put money in for even those that aren't contributing. And then the ones that want to reward those who are saving, it's 100% match on the employees' first 3% of their contributions, and then a 50% match on the next 2. So if your employee was putting in 5% per year, you would put in 4%. And remember, with these types of plans, you as the business owner is also an employee, so you can also match your own salary. So if you were putting in $24,000 a year, you could also match whatever it is, or put in a non-elective contribution of 3%. With the profit sharing plan, you can layer that on top, which we've seen with businesses that are doing really, really well, and perhaps the owner wants to max out and put the full $54,000 in. So what they would do there is, at the end of the year, they would see how much they put in themselves plus the companies put in as a match or a non-elective contribution, and then the difference. So let's say they put in 25. The difference, they'd subtract 25 from that 54, and they could put that much into the profit sharing. But then there's a calculation that you have to work through to figure out how much you'd have to put in for your employees. So that one gets a little bit trickier, a little bit more complexity to that. But these are 4 scenarios that I thought might be helpful for you to review and to think about as you're going into 2018. Because I don't think people are getting as much education on these types of plans as maybe if you work for a large company. So before we get into the Q&A, here are some takeaways for you to think about. I'm a financial planner, and I really believe in the process. So one takeaway is, get really clear on what your personal financial goals are. You've probably heard of the acronym SMART, either from your TAB facilitator or just from reading. It stands for specific, measurable, attainable, realistic, and time-bound. So, we obviously don't want to try to grow our company so quickly that we're not having any fun. We don't see our families, and we burn out. But get really clear on what those personal financial goals are, and start using those goals to help you set up your business for 2018 and beyond, on maybe how you could grow your business, your bottom line growth, not just your top line growth, so that you could pull more money out of the business and begin saving it for retirement. And also thinking about into the future on what growth projections are going to help you meet all of your needs and wants. I would also suggest that you begin planning your succession plan now, so that you're better equipped when the time is right to step away. Sometimes when we go to sell our businesses, there may be no one to buy. That's a little scary thing to think about. And other times, somebody might come to you before you're ready to sell, and you would want to know some things about your financial plan to be able to gauge whether or not the offer they're giving you is a valid one or will meet your goals. So, beginning to think about your succession plan now, I think, will put you in a much better place. And then finally, hopefully you have somebody in your life that can help review various retirement plan options to see which ones are right for you and your company, and then continue to monitor and manage those plans as your needs and for your company grows. So with that, I'd like to just say thank you, and we can open it up for questions.
Thank you, Chad. We did get a couple of questions come in. One person asked, what is the right amount I should be saving for the future?
That's a great question. Unfortunately, it's specific to everybody. One rule of thumb, if you've ever subscribed or listened to Dave Ramsey, he's one of the most syndicated radio hosts in America right now. He's helped millions of people get out of debt and get on the road to financial security. But his rule of thumb is, once you have a savings account established and you've started knocking out your debt, if you have any, that you should be saving at least 10% of what you make. So, that's one of the reasons a retirement plan is really nice, is that if you're making $100,000 or $200,000, you can take that right out of the top and deduct that. So you're not paying taxes on it. So it may look like it's costing you a full 10%, but maybe after the tax deduction, it's only costing you 80 cents on the dollars because you're saving in that tax rate. But a good goal to think about is 10%. Dave Ramsey talks about it all the time. The principles of financial planning and the principles he's teaching, they're not new. Most of our parents and grandparents used to say you should live on 70% of what you make, and that's very good advice. It's hard as business owners. We work really hard, and we do feel we deserve certain things, and so oftentimes I see people taking bigger trips or driving nicer cars than maybe they should, and so it's just some behavior changes. But if you can get to save 10% at least of what you're making, that puts you on a good path for sure.
Very good. We got another question. She asks, how easy is it to switch from a SEP to another type of plan?
That's a great question too. So it's actually very, very, very easy. We are in a little bit of a crunch time if you want to go from a SEP to a 401k plan. So to establish a 401k for next year and make sure it's a safe harbor, you actually have to get that plan established usually by middle of November, or very early part of December, because you have to give your participants a 30 days notice. So this is the crunch time for opening up a 401k plan if that's the right fit for you. If it's, I'd have to double check with a CPA or your CPA, but if you want to go from a SEP to say a simple plan, I think you have to do that before year end as well. But yeah, I would double check with that. I can't answer that specifically.
All right, we got another question that came in. Can you give some of the guidelines for the profit sharing portion of the Safe Harbor 401k?
Some guidelines. I would also say it depends. So it depends on the size of your business. So oftentimes people will hear that, hey, I can do a profit sharing. There's actually another plan on top of that if your company is doing really, really, really well called a cash balance plan. And a few of our clients have asked, what does that look like? And what it starts with is a census of your business to get a really good idea. You could either fill out a spreadsheet that we have or any other retirement planning expert would have to basically ask you to fill out how many employees do you have, who are owners, how many hours are they working, and how much did they make last year. So you could look at 2016 if it's a good representation of 2017. And then there's columns for, are you doing a 401k? Are you doing a safe harbor contribution? And then the illustration can ask you, okay, Mr. or Mrs. Owner, how much do you want to put in the profit sharing? And then from there, based on your compensation and the percent that represents of the portion that would go into your profit sharing, there's this crazy calculation that would calculate based on your employees' compensation, what percent you would have to put in for them. So oftentimes it comes down to two questions. One, can you afford to do the profit sharing plan? And two, the hard-nosed answer would be, how much will that save you in tax? And is the tax savings going to be lost because you're going to have to put money in for your employees? And that's, again, the hard-nosed answer. Some of our clients say, look, I don't care. We've done really well, and I want the employees to share in that. One thing to think about, with a safe harbor 401k plan, the contributions that the employees put in are always theirs. Some plans can have a vesting on that, but most, even the contribution that you put in on their behalf, is theirs. But when you layer on a profit sharing, you can have a vesting schedule on that. And I see that oftentimes. Like if the CEO says, I want to put in money for the employees in the profit sharing, and it can be quite a sizable amount of money, they want to make sure that employee sticks around. And so what we see is sometimes a 6-year vesting schedule on the profit sharing plan, so that if the employee were to leave in say year 3, the business would get, or the 401k plan, profit sharing plan would get some of that money back. But I can't really go into specifics because every company is going to be different. It's very easy if you don't have any employees. You can put up to $54,000 between the 401k and the profit sharing.
Wonderful. And then we have one more question. It says, I am planning on selling my business as part of my retirement plan. How does that play into all of this?
That's a great question. That's pretty much what the presentation was on. Is I think the first step is you want to know how much do you need. With a financial plan or a financial planner, that's our job, is to help you figure out, will you have enough from all of your other resources? Perhaps you have other retirement accounts or old 401ks or other investments out there. Some people have real estate. How does that all tie into the amount of money you're going to need to live on and the sources of that income? And so I was giving an example earlier where they didn't save anything, and the 401k, the business sale was the entire thing. That I rarely see that, but I'm trying to use extreme examples here. But if that was the case, then you're going to want to know, how much do I want to spend each month in retirement, adjust that for inflation, and then what's a healthy withdrawal rate from that big pile of money. Then you have that data to go to look at, what's my business valued at, and can I get that? Will my business be worth enough, as much as I need net of taxes, for me to retire? And that's a huge question. I think everybody on the call should be able to figure out. And there's experts out there that can help you with valuations. I just learned about a new tool that is coming to the market soon. It's an online tool to figure out what your business may be worth, just based on looking at the industry that you're in, and almost like Zillow, what other businesses may have sold for in your industry. So there's a lot of data out there on how to value your company.
Wonderful. Thank you so much, Chad. You can contact Chad at chad@aveocapital.com or 303-566-2005. You can check out all of our previous BOSS webinars on demand by visiting our website and clicking on webinars. There you'll be able to register for our next webinar on financial planning for 2018, which will be on Wednesday, December 6th. Thank you, everyone, for joining today, and have a wonderful rest of your day.